This is Al Brooks. Thank you for watching the Brooks Trading course. This is the second of 5 videos on trading broad bull channels. A broad bull channel, even though it's very two-sided on the time frame in front of you, if you look at a high enough time frame, it'll be a breakout in a strong trend. And therefore, if you see trading ranges on your time frame, they have a higher probability of breaking out in the direction of your trend. Reversals are common, like they are in all trends, but they fail, like in all trends. All broad bull channels contain major higher lows, and as long as the market continues to make major higher lows, it's still either in a broad bull channel or a trading range. If it falls below a major higher low, then it's either in a trading range or in a bear trend. This is a 5-minute chart of the euro versus the dollar, and it's 7 days, and you can see the market is making a series of higher highs and higher lows, and therefore it's in a bull trend, and there are many strong sell-offs along the way, and therefore I call it a broad bull channel in contrast to a tight bull channel. If you're a day trader using the 5-minute chart, you're not going to be paying much attention to broad bull channels that last more than a few days because you simply won't see them on the 5-minute chart. 5-minute chart, you're only going to see about 100 bars, and this is about 1,000 bars. You should always trade the chart that's in front of you, and if you're looking at a 5-minute chart, you're only seeing about this much of the chart, and it's a bull trend. You look to buy reversals up. If you do look at many days, for example, like this, if you're looking at 7 days, you're going to see the broad bull channel, and it makes it a little bit easier to buy. You simply buy every reversal up from a pullback as long as the market keeps making major higher lows. And you can trade it like a broad bull channel. But if you're only looking at 1 day's worth of data, you simply trade what's in front of you, and sometimes you're going to see a bear trend. If you're looking at the 5-minute chart and you see a bear trend, you're going to sell. If you are looking at several days of data and you see the channel, you're going to be looking to buy reversals up in the lower half of the most recent bull leg. So a bull leg, you want to buy a reversal up from somewhere in the middle of that leg. We have a bull leg, you want to buy reversals up from somewhere in the middle of that bull leg. Bull leg, when it pulls back to the middle, you buy a reversal up. And also, you want to buy reversals up after a break below a minor low. For example, this is a minor low. The market broke below it. You're going to buy a reversal up. If you're not looking at a 5-minute chart and instead you're looking at a higher time frame chart, like maybe a 60-minute chart, you know the market is in a bull trend and you want to buy. If you see a pullback, some traders will put up a 5-minute chart to find an earlier entry. Here's a 60-minute chart of that same series of days, and you can see that it's still a bull channel and it's fairly broad. If you look at an even higher time frame chart, it would be a pretty tight channel. Broad bull channels spend a lot of time going sideways, and there are times, for example here and here, that not only is it still in a broad bull channel, it's also in a trading range. And when it's in a trading range, you trade it like a trading range. You look to buy low, sell high, and scalp, take quick profits. Because it's also a broad bull channel, you can also trade it like a broad bull channel, and you can simply buy and swing trade until it's no longer clearly in a broad bull channel. For example, we're getting higher lows. We have higher highs here. Some traders will buy this reversal up and hold overnight. Remember, this is a 60-minute chart, and you use the appropriate stop. This is a fairly major higher low, even though this reversal did not go to a new high. The bears tried to sell off. They tried to sell off again. It got down to the area of the bottom of the buy climax bar, the bull breakout bar, and reversed up. You can also, instead of buying and holding overnight, you can simply buy during any session. You see a breakout on the open of the session. You see a bull flag and a reversal up. You can see a high 2 buy, 2 legs down, 1 pullback 2, and a reversal bar. And you can also exit at the end of the session if you want, or on a reversal down. Here's a 240-minute chart, a 4-hour chart, same thing. And the channel is fairly tight on a 240-minute chart. Even though on the 5-minute chart and 60-minute chart, it was a fairly broad channel, on the 4-hour chart, it's a fairly tight channel, and you're going to have a very hard time making money selling. When a channel is tight and you look at it and you see that it's difficult to make money selling, you should only look to buy. And that's one of the important differences between a tight channel and a broad channel. In a tight channel, it's difficult to make money selling, and you should only look to buy. Even though on the 5-minute chart, these sell-offs are big enough to sell, on the 240-minute chart, they are not. And since you're only looking to buy, you can look to buy any reversal up if you're looking for stop entry trades. After each new high, especially if there's a strong breakout, traders will raise their stop to below the most recent major high or low. A strong breakout, then this becomes a major high or low here or here or here. We have a breakout here, not all that strong, but at this point it clearly is strong. If your stop was down here, you would raise it here because this now is a major high or low, a strong breakout to a new high. Remember, a chart that's in a broad bull channel spends a lot of time going sideways. And when it's sideways, you can trade it like a trading range if you want, and you can sell high. Here, the channel is so tight that it's really difficult to make money selling. If you happen to use a tight stop, for example, let's say you bought above the high of this bar right here, and you get stopped out there, it's still a bull channel. You'll buy again on a reversal back up, for example, right there. Very tight channel again. When that's the case, you should not be thinking about selling at all. You should only be looking to buy, and preferably swing trade. Like in all bull trends, reversals are common, but most fail. Remember my 80% rule. If the market's in a bull trend, 80% of the reversal attempts will fail. Again, this is 7 days of the euro versus the dollar, 5-minute chart. And you can see lots and lots of reversals. This is 150 bars on the 5-minute chart, and within it there are many reversals. We got a strong breakout below the trading range, below a significant higher low. This is probably a major higher low. Even though we did not go to a new high, we sold off strongly and we reversed up strongly, so that makes this pretty major. But a lot of times you'll get 2 legs down, 1 pullback 2 when the market's in a trading range, and therefore traders will look to buy a reversal up if we break below that low. We're probably always in short on the 5-minute chart here, and maybe here as well. And that's common. When the market's in a broad bull channel, there are often areas where it's always in short. And if you're trading the 5-minute chart, you'll be swing trading shorts during that session. You buy the reversal up, you buy the reversal up. This is a double bottom with that low, or with this low. It's a double bottom, slightly higher low, 2 legs down in a trading range. In broad bull channels, you also often have 2-legged moves, big 2-legged moves, and the second leg falls below the first. But if the market reverses up, traders will buy. Once it falls below a major higher low like that, the market then is either in a trading range or a bear trend. Up to that point, up to this point, when it breaks below that major higher low, it's either in a trading range or a bull trend. At this point, it's a trading range or a bear trend. When it reverses up strongly, now it's back to possibly a trading range and a bull trend. If it's a bear trend, it should not have reversed up strongly again like that. strong sell-offs, the market is always in short on a 5-minute chart. Again, this is 7 days and maybe 1,000 bars. But if you're just looking at one session, these stretches here of deep selling make the market always in short during that session. And if you're trading that session, you sell. Bulls expect that every reversal attempt will fail because we are in a broad bull trend, broad bull channel, and therefore the bulls will buy reversals up. And they'll look at all of the sell-offs as some kind of a double bottom, a test of support, test of a prior low. So a higher low double bottom, a lower low double bottom, double bottom, double bottom, small double bottom, and they'll buy reversals up. Remember, all trends are always trying to reverse. Broad bull channels are trends, and therefore they're always trying to reverse. They'll often have double tops and major trend reversals, but most will fail. 80% of them will fail. Markets have inertia. That means they resist change, and every attempt to reverse will probably fail. We have a bull trend, a bear breakout, lower high, major trend reversal. All major trend reversals only have a 40% chance of success regardless, and therefore chances are, even though it's a reasonable sell, it's not going to lead to a bear trend. It'll lead to either a trading range or possibly a resumption of the bull trend. Here we have a wedge top, 1 pullback, 2 pullback, 3, and it started the sell-off, and we got 2 legs sideways, but not 2 legs down. The reversal attempt from the wedge failed. Another double top, you can call it a higher high major trend reversal. Now we have an expanding triangle top, tried to reverse down, but we have 2 legs, and the bull trend continued up. And lots of little triangles here, and then here, yet the market continues higher. Another wedge top here, market continued higher. And bulls know that the market's in a broad bull channel, a bull trend. Therefore, they expect the reversal attempts to fail, and they'll look to buy a reversal up. Or they'll simply hold long and use a wide stop and ride through the entire bull trend. All broad bull channels spend a lot of time in trading ranges, but because the market's in a trend, these trading ranges have more than a 50% chance of having a bull breakout, a breakout in the direction of the trend. Most trading ranges have only a 50% chance of trend resumption up and a 50% chance of trend reversal down. But when a trading range is occurring within a broad bull channel, it's a bull flag on a higher time frame chart, and the odds are you're going to get a bull breakout. Anytime you get a pullback that falls below a significant higher low or below a trading range or below a trend line, for example, you might be starting to enter a trading range. And all trading ranges contain topping patterns and bull flags. Trading ranges are constantly trying to reverse, but because you're in a broad bull channel, a bull trend, most of these reversals will fail. You'll often break below a bull trend line, yet you will not get a bear trend. You'll simply form a broader, flatter bull channel. We broke below a trend line. Did we become a bear trend? Well, we had a couple legs down, but this low is above that low. We still might be in a bull trend. You can draw a new line once the market reverses up here, and it's a flatter trend. This trend line is flatter than that one, not as steep, but it's still going up. This low broke below there. It reversed up again. You can draw another line, and we're still in a bull trend, but the slope is not as steep as it was originally. Every time it breaks below a prior line and reverses up, you can draw a new line, but as long as the lines keep going up, you're still in a bull trend. Same thing here. We have a bull trend line here. We broke below it. We reversed up. You can draw another line, and you can keep drawing lines with every reversal up. But the lines are all rising, and therefore the market is still in a bull trend. Still a broad channel. Not parallel, but still a broad channel. The two pink lines. Again, still a broad channel. The two blue lines, still a broad channel. Eventually, every bull trend evolves into a trading range, and that's especially true of a channel, which already has a lot of trading range price action. On this chart, we're still in a broad channel. Maybe this is the start of a trading range. We don't know because we do not see the bars to the right. But if you have a bull channel, 75% chance you're going to get a bear breakout below the channel and eventually evolve into a trading range. Only 25% chance when you're in a bull channel, you're going to get a strong bull breakout and the market cycle is going to start over. Breakout, pullback, and then another channel. Every time the market breaks below a trend line, the channel becomes broader, the distance between the top and the bottom becomes greater, and also the channel becomes flatter. I want to talk a little bit about major higher lows. As long as the market's making major higher lows, it's still in a bull trend. Strong rally to a new high, and therefore this low is important. It's major. As long as the market does not fall below this low, it's still either in a bull trend or a trading range. That would result in a major change in the market cycle from a bull trend to a bear trend. And therefore, this has significance. It's important. And every time the market breaks strongly to a new high, the start of the leg up is major. Strong breakout to a new high, this becomes a major higher low. Strong breakout to a new high, this is now a major higher low. As long as the market then stays above that major higher low, it's either in a trading range or still in a bull trend. Broad bull channels always contain trading ranges, and trading ranges always contain topping patterns, reversal patterns. Now, is this a major higher low? We have a pretty strong reversal up. We sold off strongly, we reversed up strongly, even though it did not go to a new high. I think this is major. But here the market fell below a major higher low. And therefore, at this instant, it's no longer in a bull trend. It's in either a trading range or a bear trend. Once it reversed up again, then it's back to a bull trend. The same right here. This is a higher low. We have a pretty strong breakout to a new high. Therefore, this higher low is major. If it falls below that, then instead of a bull trend, the market is in either a trading range or possibly a bear trend. It did not take long for the bull trend to resume, and then it's either in a trading range or a bull trend. At any time, the market's either in a bull trend and a trading range or a bear trend and a trading range. Is this a major higher low? We have a reversal up, but not very many bars and did not get to a new high. And therefore it's minor. If the market falls below it, it's still in a bull trend. and you have to assume the odds are the breakout's going to fail and the market will resume up. Even if you have a strong breakout and the market becomes always in short, if it quickly reverses up, the bull trend will quickly resume. Whenever the market's in a broad bull channel or in a trading range, it often has a strong second leg down, and the market often becomes always in short on that second leg down. But it's usually a second leg trap. So leg one, pullback, leg two, making everyone think the market's now in a bear trend, but usually, more often than not, it's a trap, trapping traders into thinking it's a bear trend, but the bear trend is going to quickly reverse up and the bull trend will continue. As long as any bear swing remains above the most recent major higher low, the bear swing is only a minor higher low in the bull channel. The bulls will overwhelm the bears and the bull trend will resume. So strong bear leg, it fell below this low but not below these lows, the bulls won. A strong bear leg below that low but not below this low or this low, there's still a reasonable chance it's simply a pullback, and the bulls will be able to overwhelm the bears and make the bull trend resume. Again, anytime there's a sell-off, bulls will buy a reversal up, especially if it's a sell-off below a relatively minor prior higher low. Every bull channel, even if it's broad, is a very tight bull channel on a high enough time frame. And because of that, when you see trading ranges in the bull channel, the odds are the trading ranges will have a bull breakout. In all bull trends, reversals are common, but whenever the market's in a bull trend, you have to assume the odds are 80% of the reversal attempts will fail and the bull trend will resume. Pay a lot of attention to major higher lows in bull trends. As long as the market continues to make major higher lows and does not fall below major higher lows, the bull trend is intact. If it falls below a major higher low, it's then either in a trading range or a bear trend. If it quickly reverses back up, it's then back to being in a trading range or a bull trend. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on trading broad bull channels.